So what kind of tax breaks can you get as a real estate investor? It's really just incredible. So when you own investment property, you can deduct the mortgage interest, the property taxes, insurance, maintenance, repairs, professional fees, education, and even travel. Again, talk to your CPA. We have a wonderful list of CPA to understand which deductions that you can take and that you can't take. So don't take my word for it. Just talk to them to see what applies to you and ask about all these things. Depreciation means that you can write off the house as if it were worth nothing in 27 and a half years. It's very strange, but that's how the tax law is written in regards to depreciation. So basically the way it works is you take 80% of the value, which is basically the structure, the property, not the land. The government won't let you depreciate land because they don't see that as wearing out, but they see the house as wearing out. Of course, many of us live in homes that are much older than 27 and a half years. So it's really not true that a house wears off or in 27 and a half years. I mean, Rich and I just bought a house in Malibu that was built in 1925. Of course, it really looks like it was built in 1925, but hey, it's Malibu. So, houses can obviously last longer than 27 and a half years, but you get to depreciate it this way, 80% of the value. Unless you're in California, they might consider the land value higher than that. But in most of the countries, this is a general rule that works. You take the structure and divide it by 27 and a half years. So if you bought a $100,000 property where the land might be worth $20,000, you times it by 8, so that's 80,000 divided by 27 and a half years. That's a 2,909 annual deduction that you get to take for that. Again, talk to your CPA, because if you make too much money, you can't necessarily take these deductions this year, but you can take them eventually. So again, that's not my specialty, but something to bring to your CPA to discuss. But make sure your CPA understands real estate. I've had so many people come to us at Real Wealth Network and say, my CPA said this or that, and we were scratching our heads thinking that, again, I'm not a CPA, but that doesn't sound right. So not every accountant is an expert in everything. You always want to pick an accountant who is an expert in the thing that you're doing. And so if you are a business owner, you would probably want an accountant who really understands the deductions you can take from business. But if you're a real estate investor, you really need to work with an accountant who understands all the deductions that you can get as a real estate investor. And even better yet, if that accountant invests in real estate also, then they're really going to know the tax breaks because they're obviously using them themselves. Now, a 1031 exchange is a way to defer the capital gain. So let's say you bought a property. I'll just give a recent example of somebody who just sold their condo in Mountain View for $1 million or something like that, and they paid $500,000 for it years ago. Of course, the San Francisco Bay Area does that kind of thing, and the gains are pretty incredible. So if you were to just sell the property, you'd have a $500,000 gain. And if it were an investment property, well, you'd have to pay capital gains on that, which could put you in the 20% category. So, that's a sizable amount of money, $100,000. But if you did a 1031 exchange, you could just defer the capital gain, so you don't have to pay it till later, and then be able to take that. You'd have to buy $1 million worth of property elsewhere, but I just showed you how you could do that buying 10 houses somewhere else. So I'm a huge fan of the 1031 exchange because I can't stand to see people in the San Francisco Bay Area or other high-priced markets where they have so much invested in one property. That is not diversified, in my opinion. If you own a property, let's say in San Francisco, worth $1 million, you have $500,000 equity in it, and let's say there's an earthquake. Well, you're not going to have any income for a while, and you're going to have to wait for the insurance. And what if it's a bad earthquake? Now, that one property is in trouble. But what if you had exchanged it for 10 properties that are in different parts of the country? Let's say there was a natural disaster in one of the areas where you invested, and one of your homes, got damaged, and you weren't getting income from that. You have 9 other homes in other areas that, it's not really going to affect you too much to just have one home that's not paying you. So I really have been encouraging people to diversify. Do not have your nest egg in one basket. In a high-priced market, it's just not wise. It's not wise to be not diversified anywhere. I have friends who have all of their retirement as stock options in the one company they work for. And I had someone else I talked to this morning who had put all of her money in Apple. And, it's just risky. It's risky. So it's the same thing with property. And the 1031 exchange is an opportunity for investors to be able to do something different and not have to pay the gain at that time. It just gets pushed off later until you die. And if you still have those properties and you die, then your children or whoever inherit those properties, it steps up to current market value and they don't have to pay the gain. So it's and that's current law. That can always change. But the 1031 exchange is just a really wonderful opportunity, especially for those of you who love timing markets. One of our own staff members, I won't mention who, but many of you already know, he just sold his property in the East Bay and had, just 6 or 7 or 8 offers, and many of them way over asking price. So he timed it so beautifully, selling his property, and then is buying elsewhere where it's not at the peak of the market. So if you like selling at the peak and buying at the trough, now's the time. You can sell your high-priced property that we know is in a bubble right now and exchange it tax-deferred for properties that are just the beginning of their boom cycle. Really, really great opportunity. And you can buy real estate within your IRA. This is such a common misconception that you can't, or that you have to take the money out of your IRA and pay penalties, or borrow from the IRA and pay interest back and have it paid back in 5 years or whatever. People have all sorts of ideas about this. But if you go into your financial planner's office and say you'd like to invest in real estate, they'll kind of look at you and say, you can't do that. And they're right. You can't do that with certain brokerages who don't invest in real estate. If you're going to your broker and saying, I want to buy real estate, they're going to look at you and say, well, you can't do that because you can't in their brokerage firm, because they only invest, say, in the stock market or in REITs or whatever. So if you really want to invest your IRA in real estate, you have to self-direct it. You have to take it out of that brokerage house and into a custodian who will allow this. So you could do it with your 401k, which is really a great option for your real estate. But basically, you can self-direct it. We have 5 or 6 self-directed IRA companies that we recommend. You could talk to all of them and compare fees and rates, and you could talk to members in our network who've done it. I've done it. It's very common to do and not difficult at all. You just talk to the custodian, and they do it actually all for you. And then you can buy real estate, or I should say your IRA can buy real estate. You are not supposed to have anything to do with it, just your IRA, but you can direct your IRA. And your IRA can buy real estate, buy and hold or own notes, and then all the gain just goes right back into your IRA. If you sell that property, or the cash flow goes right back into your IRA. You can even get financing. Your IRA can get financing so that it can buy more real estate. So again, common misconceptions there, but absolutely legal, and people do it all the time.